So here's a fun game. Next time oil prices spike, I want you to do something. I want you to go count how many barrels of actual oil changed hands because of the news that caused the spike. Spoiler, it's zero. It's always zero. Nobody pumped less oil. Nobody's tanker didn't show up. Somewhere, a guy in a suit looked at a headline, and barrels of oil that exist exactly the same as they did 5 minutes ago suddenly became more expensive. We're told the oil market is the purest expression of supply and demand on Earth. Real commodity, real scarcity, real stakes. And sure, sometimes that's true. Sometimes there's an actual war happening and actual oil actually stops flowing through an actual strait, and yeah, in that case, no kidding, prices go up. But I want to talk today about the other thing. The thing where the market doesn't just respond to reality, it sprints 10 miles ahead of reality on a need-to-know basis, where apparently it never needs to know when things get better. Let's talk about 2026. What actually happened? Quick recap for anyone who wasn't watching the futures board like it was a heart monitor. Late February, a US-Israeli conflict with Iran kicks off. The Strait of Hormuz, that's the narrow stretch of water that something like a fifth of the world's oil has to pass through, gets effectively closed. This is not a drill. This is a real, enormous supply shock. By May, the International Energy Agency is reporting something like 12 to 13 million barrels a day in lost global supply. That's not a rounding error. That's one of the biggest supply disruptions in the history of the oil market, and that's not me being dramatic, that's a direct quote from people whose job is to not be dramatic about this stuff. Brent crude, the global benchmark, started the year around $61 a barrel. By the end of the first quarter, it's up near $118. By early June, you've got Exxon and Chevron, companies that, again, profit when this number goes up, telling everyone Brent could hit $150, maybe $160 a barrel. Fine. Genuinely fine. Real war, real disruption, real price increase. I'm not the guy yelling that this part is fake. If you shut off a fifth of the world's oil supply, prices should go up. That's not a conspiracy, that's a vending machine working correctly. And to be fair, this isn't even unprecedented. Go back to 2008, WTI hits $147 a barrel, an all-time record, driven by genuine demand growth and tightening supply. Go back to 2022, Russia invades Ukraine, oil jumps past $120. Real events, real prices, real cause and effect. Nobody needs a tinfoil hat for any of that. The market did its job. So when I tell you 2026 is different, I'm not asking you to throw out the rulebook. I'm asking you to notice the one chapter where the rulebook stops applying. Here's where it gets interesting. The part that doesn't add up. At the same time all of this is happening, and I mean the exact same window, there's also active diplomacy going on. Real negotiations. At one point the president is on record saying a deal over the Strait of Hormuz could happen within about a week. And the market's reaction to the conflict might be resolved very soon was, and I'm being generous here, a shrug. Multiple analysts flat out said it. Markets largely discounted the optimistic news. 3 straight sessions of gains during a week when the headline was de-escalation is on the table. Sit with that for a second. The actual physical supply of oil didn't change in that moment. Nobody's tanker started moving again. What changed was a sentence somebody in Washington said out loud. And the market's response to maybe this gets better soon was to keep pricing in the worst case anyway. There's actually a tidy little explanation for this, and to be fair to the market, it's not a stupid one. When diplomatic signals and military signals point in opposite directions, traders default to pricing in catastrophe until they get hard proof otherwise. Hope is not a hedge. Nobody wants to be the trading desk that bet on a peace deal and got it wrong. Okay. Reasonable. Except, notice what that actually means in practice. It means bad news gets priced in immediately at full strength, no questions asked. And good news gets treated like a substitute teacher. Technically present, not actually trusted to run the room. That's not a neutral, symmetrical market processing information efficiently. That's a market with a structural thumb on the scale. And the thumb only ever pushes one direction. Think about what it would take for the opposite to happen. Imagine a headline drops tomorrow that's pure good news. Let's say a real, signed, verified ceasefire, tankers already moving again, satellite photos and everything. Do you think oil drops 8% in an hour the way it spikes 8% on a rumor of an attack? Or do you think it drifts down over a week, with 3 different analysts on financial television cautioning everyone not to get ahead of themselves? Actually, we should wait and see if this holds? I think you know which one happens. We've all watched this movie before. Who benefits from the thumb? So here's the question I actually want to ask, and it's not, Is there a secret room somewhere with executives twirling mustaches? Nobody needs a secret room. That's the lazy version of this theory, and frankly, it's a little insulting to how good these systems are at producing the same outcome without anyone having to whisper. The real question is, who is structurally rewarded every single time the market overreacts to bad news and underreacts to good news? Start with the obvious one. OPEC Plus is not a secret cartel. I want to be really clear about that because it gets treated like some shadowy reveal, and it's not. It's their stated, public, diplomatically acknowledged mission. A group of oil-producing nations getting on a call and agreeing to manage output specifically to manage price. That's not an allegation. That's their job description. It's printed on the website. They meet, they announce production targets, they explain, out loud on camera, that the goal is market stability, which is a polite way of saying a price we're comfortable with. When they cut production, prices go up. When they're worried prices are going up too much and demand might collapse, they ease off a little. That's not a deep secret. That's a press release. The only conspiracy here is that everyone agreed to stop calling it a conspiracy and started calling it monetary policy for oil instead. Then you've got the producers, Exxon, Chevron, the super majors, who sure don't control geopolitics, but who also don't seem to be in any hurry to talk the market down. Funny how it's always the oil companies' analysts quoted predicting the scarier number. 150, 160 a barrel. Never the guy at Exxon going, actually guys, I think we're overreacting, settle down. When was the last time you saw an oil executive quoted talking the price down? Oh wait. And then there's the part nobody puts on a t-shirt, the trading desks themselves. A relatively small number of institutional players move enormous volume in this market. When the data shows rising prices and rising open interest, meaning new money flooding in, not just existing positions getting nervous, that tells you something. That's not panic. Panic is people running for the exits. This is people running in. Somebody is buying every single one of those overpriced contracts. Somebody is on the other side of every panic trade. And whoever that is does not lose money when the market overreacts. They lose money when the market calms down. Put it together and you've got three groups. Producers who set supply, a cartel that openly manages price, and a small number of trading desks that dominate volume, and every single one of them does better, financially, when the price is higher and the fear is louder. Not one of them is structurally incentivized to be the voice of, hey, maybe pump the brakes, this is overblown. That voice doesn't have a seat at any of these tables. It doesn't need to be silenced. It just was never invited. So when I say kept artificially high, I don't mean a cabal. I mean an incentive structure where fear is profitable, calm is not, and the people closest to the information are the same people positioned to benefit from everyone else's panic. You don't need a conspiracy when the system just naturally rewards the behavior you'd expect from one. The just trust the model's defense. Now, the official defense of all this, and I want to steelman it because it's not a dumb defense, is that this is just how forward-looking markets work. Futures prices aren't a snapshot of today. They're a bet on tomorrow. Of course they overreact to scary headlines. That's the whole point of a futures market. It's supposed to move before the bad thing fully happens, not after. And look, there's truth in that. I'm not going to sit here and pretend futures markets are supposed to behave like a thermostat, calmly tracking the actual temperature in the room. But, the system is designed to overreact, is not actually the comforting explanation people think it is. Because the question isn't whether overreaction is built into the design. The question is, who designed it, who benefits from it staying that way, and why is, calm down, the deal is probably happening, apparently the one piece of information this incredibly sophisticated trillion-dollar pricing mechanism simply cannot process? A system that is excellent at pricing in fear and bad at pricing in relief isn't a neutral information processor. It's a system that's very good at doing one specific thing. And it's worth asking who that one specific thing is good for. Hint, it's generally not the guy filling up his tank. The pump test. Here's a test you can actually run yourself the next time you're standing at a gas station watching the numbers click over. When crude spikes on a Tuesday because of a headline, how long does it take for that to show up on the sign outside your local station? In my experience, by Wednesday. Maybe Thursday. Fast, efficient, practically instantaneous. Now, when crude drops because, say, the scary headline turned out to be overblown or a deal actually got signed, how long does that take to show up on the same sign? Funny how that direction always seems to need a little more time to work through the supply chain. The same supply chain that moved at lightning speed in the other direction just last week. This isn't a new observation, by the way. It's documented, it's been studied, and gas station pricing behavior alone has had entire investigations built around it in different countries over the years. I'm not telling you something nobody's ever noticed. I'm telling you it keeps happening anyway, year after year, war after war, headline after headline, and somehow it never quite gets fixed. Who pays for this? Because let's not lose the actual human cost while we're admiring the elegance of the incentive structure. Every time Brent jumps because a diplomatic sentence got discounted, that shows up at the pump. It shows up in airline ticket prices because jet fuel isn't optional. It shows up in the cost of literally anything that has to be shipped, trucked, or flown anywhere, which is to say, everything. And the asymmetry compounds. Prices go up fast on bad news. They come down slow even on good news, assuming the good news ever fully gets priced in at all. Economists actually have a name for this because it's so consistent it's basically a law of nature at this point. It's sometimes called the rockets and feathers effect. Prices shoot up like a rocket. They drift down like a feather. So you end up with this one-way ratchet. Bad news, instant, full price. Good news, slow, partial, grudging, maybe eventually price. Run that pattern over enough news cycles and you get a market that's permanently biased toward as expensive as possible, justified by whatever the scariest available headline happens to be that week. Nobody had to conspire to build that ratchet. They just had to notice it works and not be in a hurry to fix it. Close/takeaway. So is there a conspiracy? Depends what you mean by the word. If you mean a room full of people deciding in advance to lie about supply and demand, probably not, and honestly you don't need one. If you mean a system where fear is rewarded, calm is punished, a small number of players control the bulk of the action, and the people best positioned to interpret the news are the same people best positioned to profit from everyone else's panic, well, I don't know what else you'd call that. Working as intended feels a little too generous. I'll leave you with this. Nobody had to design the rockets and feathers effect on purpose. Nobody had to sit down and engineer a market that sprints on bad news and crawls on good news. They just had to inherit a system that already worked that way, notice it was extremely profitable for the people closest to it, and decide that fixing it wasn't really anyone's job. That's not a smoking gun. That's just what happens when nobody with power has a reason to want the gun found. The next time oil jumps 8% on a headline that didn't actually take a single barrel off the market, and it will happen again probably before this episode finishes uploading, I want you to ask the only question that actually matters. Who was buying while everyone else was panicking? Because that's not a rhetorical question. Open interest data exists. It's public. Somebody was on the other side of that trade. It's never nobody. It's just rarely the person paying $80 to fill up a sedan. That's the show. Thanks for listening. If this resonated or if you think I'm completely full of it, let me know either way. I'll see you next time.